Hello viewers, welcome to the session on financial management. In this session, we are going to study the topic family expenditure and financial management. We will try to enable the students to understand the factors influencing family expenditure, types of expenditure, income allocation and types of budget, record keeping and estimation of income and expenditure. We will try to estimate income and expenditure. To begin with the introduction, income management, like other management processes, involves planning, controlling and evaluation. The effective management of income involves two types of plans: family's financial plan and family's spending plan. The family's financial plan includes the entire financing of all needs of the family members, whereas spending plan is preferred for a specific period. Both of these are interrelated. The main purpose of these is to achieve the desired quality of life through effective income management practices. The main objectives of income management are all-round development of the family members, enhancing their happiness and health by making the best use of the income of the family. Family budgets help in good financial management. Family income management. Factors influencing variation in family expenditure. Family expenditure shows the standard of living of any family. The factors influencing the standard of living are: the first one is income. The size of income influences the standard of living, since it determines the buying capacity and the consumption level of the family. The second one is wealth. Accumulated wealth influences the standard of living, as a wealthy man would like to maintain a high standard of living. The third one is ratio of size of family to size of income. A small family with a given income can certainly enjoy a better standard of living than a big family with the same income. The fourth one is price level. Price level determines the real income of the people. A low price level leads to high real income, and a person with high real income can have better living standard. Education and individual taste. It differs from person to person, and these are powerful sources which determine the standard of living of particular person. An educated person prefers to have a better pattern of consumption as compared to an illiterate one. Religious dogmas. Religion advocates simple living standard. A religious person or a family believes in simple standard of living. Economic system, which a country has, also affects the standard of living of its people. In industrial economy, the standard of living is higher than the agricultural economy of the country. Social environment. The cultural and surroundings of social environment also influence a family's standard of living. In a posh locality, people have a better living standard. The ninth one, income and number of dependents. Standard of living depends upon the income of family and number of dependents. If dependents are few, the standard of living is high. The 10th one, class of the individual. The class to which individual belong affects standard of living. It is rather different for a family to deviate from the standard set by class to which they belong. Different classes have different standards. We are now going to look at the types of expenditure. Money spent for the fulfillment of family goals and requirements is known as expenditure, which it depends upon the capacity of family members to earn money and their real and psychic income. Family expenditure is actually of three types. The first one is fixed expenditure. This is a fixed expenditure and no reduction is possible in it. For example, house rent, school fee, pay of the servant, etc. The second one is semi-fixed expenditure. Expenditure on certain items can be increased or decreased, such as expenditure on food, clothes, etc. In case of marriage or festival at home, expenditure on clothes increases. Similarly, if there are some guests at home, then expenditure on food also increases. The third one, other expenditure. It is not a compulsory expenditure. Such expenditure is made if some money is left after spending on fixed and semi-fixed expenditure. Such expenditure is made on entertainment or on veins of luxury and comfort. The next one is income allocation. The typical income allocation for the three types of family expenditure can be explained through the Engels' law of family expenditure, Engels' law of consumption. Ernest Engels, a German, in the year 1857 conducted study on consumption. He studied consumption patterns of different income groups and collected information on family budgets of working class, middle class and rich class people, and framed three rules on family expenditure. These rules are known as Engels' law of family expenditure or Engels' law of consumption. It is applicable to all the sections of the society. The law states that whenever the income of the consumer increases, the proportion of income spent on food decreases. The second one, whenever the income increases, the proportion of income spent on clothing, fuel, light and rent remains the same. The third one is, whenever the income increases, the proportion of income spent on comforts of life such as education, health, recreation tends to increase. Thus, the smaller the family income, the greater the proportion of it absorbed by food and other elementary necessities, and greater the family income, the higher the proportion spent on comforts and luxuries. Engels' law holds true to certain limits, but with the passage of time, this needs to be improved due to the modernization and changes in the family needs. Budget, types of budget. What is the meaning and definition of budget? A budget is a carefully thought out plan of spending the money available for the required period of time. Apart from spending the available money for meeting our wants, saving a part of the money is also important, since saving of a part of the money is useful for meeting future requirements. Hence, family budget means a plan of using available money wisely for necessary expenditure, and also a plan for saving a part of the money for the future needs. This naturally involves estimating of what the income will be during a period and how much is to be spent on different items of expenditure and what part of the income is to be saved. Hence, budget is briefly described as a financial plan for future expenditure. The definition of budget: a budget is a plan for spending and saving within a given income for a definite period, say a week, a month, or a year. Types of family budget. Family budgets are divided into again three types. The first one is surplus budget. A budget shows a surplus of income over expenditure when expenditure is lower than income. The second one, deficit budget. When a family incurs more expenditure and the income is low, there shall be a deficit in the family budget. This may force the family to borrow and there will not be any savings. The deficit budget is not good for the family. The third one, balanced budget. When the expenditure and income of a family tally each other, there is neither a surplus nor a deficit. This type of budget is an ideal one and does not lead to tension. Advantages of budgeting. Family budgets have useful role in managing money income wisely. Budget making in a family gives direction to use money income properly and to the advantages of the members of the family. Family members are made to think collectively regarding the use of money income in a planned way on a priority basis. Budgets are useful in adjusting, regulating, or modifying the expenditure in case of shortage of income or irregular income. Budgeting helps the family in making savings out of its income. Family members learn to live according to their income through budget making. Planned budgets help in good buying habits in order to balance income and expenditure. Children and youngsters get some experiences in spending money income in a planned way. It gives them some pleasure and also they get confidence in handling money. Family member gets motivated to cooperate with each other and interact and adjust among themselves. Family budget making helps members to learn how to enjoy leisure and spend money. It encourages conscious decision making which may help in reflecting long-term goals in the budget. Budget also forces one to decide what one wants most out of life. Family budget indirectly determines the use of other resources and the kinds of interest which the family is developing. There is no scope for tension and stress in managing money if budgets are prepared for expenditure and savings out of the income during a particular period. The major advantage of making a budget is that it enables a family to take an overview of its money. Steps in making budget. The steps that are involved in developing a budget plan are: the first one, estimating or estimation of income. The total income of the family must be estimated before developing a budget. The total income includes income from sources like salaries, wages, interest, rent, dividend, etc. Estimating family income. Family income flows in to the family treasury during short and long periods. A family has to maximize value of the income, hence it has to recognize that some of the short time flow makes up the long time stream. The process of fitting the use of short time income year by year into long time picture in order to make the long time stream meet predictable needs is the real essence of these guidelines. Planned approach to finance family living requires that the family should foresee future needs based on knowledge of how the family will develop and arrange to have funds to meet these needs. In analyzing the financial gains, the current quantity of income, certainty of source and pattern of income flow are predicted over a period of time, that is a year, annual income. Occupational choices affect the regularity and characteristic flow of income and the financial planning that is possible. The standard of living that can be exchanged for financial resources is dependent not only on how much income is available, but even more importantly on the regularity and stability of income. For salaried workers with a regular employment, money income is usually predictable not only by the year but also over lifetime. Both time periods must be considered to be realistic for those who have really to manage irregular income, and with uncertain employment, planning is more difficult and more necessary. So, The second one is listing out items for buying needed for the family, and also list out the services needed by the family members throughout the budget period. The third one, finding out the prices of the concerned items from shops, friends, etc. Estimate the cost of desired items, total classification, and strike the total for the budget. Past records are helpful in this connection. For example, bills, checks, receipts, etc. And the fourth one, listing of items of fixed costs like rent or taxes, etc. The fifth one is priority list of items and anticipated items to be prepared. The sixth one, keeping aside a definite amount for saving to meet emergency expenditure or for future benefit. The seventh, bring expected income and expenditure in balance. Let us now look at the record or account keeping. Record keeping is useful in different ways in managing family income. The first one is, record keeping is useful in knowing the exact amount of money spent or a particular item, say food, fruits, etc. The family can know through record keeping the past expenditure in a particular emergency. This will give an indication of what the family may expect in future. The third one, records can serve as a control over family budget. Expenditure on a particular item may be in excess of the normal amount in the past. This may help the family in curtailing the expenditure on such items in the future. The fourth one, records are useful for income tax purposes. In certain cases, information on household expenditure is needed for income tax returns. The fifth one is, a study of records will show in which month the family has measured extra expenditure and why. The sixth one, from the record, the family will learn whatever it has made a wise buy or not. The records can be useful for income-based purposes. Expenditure of realized income in terms of money or cash expenditure, and in terms of real income, where goods form an appreciable part of the realized income, come under short-term records. These records are called household accounts. Long-term records. Long-term records concern items of a permanent nature such as property owned, other investments, and all indebtedness. The involved time period in these records is long, hence a family may not be able to remember or recollect all expenditures as it has made during the period. These records must be as complete and adequate as possible. They are ledger and balance sheet, the net worth. Let us study the classification of records. There are three types of records. The first one, household accounts. Records relating to current cash expenditure from money income are commonly called household account. Account keeping system. There are four types of accounting system. The first one, sheet method. In this simple method, the records of expenditure may be kept on a single, double, or multiple sheets. It is convenient to use since the sheet can be tacked on the back of the board, the end of a cabinet, back of a door, hung along with pencil. This method is simple and flexible. Single sheet method, all items of expenditures, total income, taxes, and savings are noted on a single sheet. In double sheet method, savings and taxes and saving are noted on a single sheet. Double and multiple sheets are better than single sheet method. The second one is envelope method. Two types of envelope systems are possible here. They are cash payment method and the second one, pure sheet accounting system. In cash payment system, money is divided into previously planned amounts and money for each group is placed in separate envelope to be dispersed with as and when the need arises. example food, housing, etc. Total money and expenditure can be specified on the cover. This system could be used by people who receive their weekly wages and who operate mostly on a cash method of payment. This system brings planning and accounting close together. It is suitable for people whose resources are meager. The system is direct and simple, highly flexible, adequate, and convenient if money for a change is anticipated and supplied. The third one is notebook method. Household accounts may be kept either a bound or loose leaf notebooks. Loose leaf book are very convenient, and it has the advantage of being more flexible because new pages can be added and old ones can be replaced whenever necessary. The notebook system demands planning of the type of accounts to be kept. The family will have to judge what items occur frequently so that sufficient space is there for them, and what occurs less frequently so that they can be grouped together. The fourth one is card file account system. This is highly flexible method since card can be kept for each type of expenditure. It can be adequate, but it may not be simple or convenient for a person not highly conscious of organization. But this might be useful for families which are also doing business and where household accounts are important also from the tax point of view. The next one is ledger. A ledger is permanent record showing assets and liabilities of a family. It holds full dates for identifying of assets and liabilities. Current household expenditure accounts are recorded in ledger. However, it may not be suitable for recording household accounts since the family assets and liabilities are not much to be recorded or reported. It is most suitable for open accounts for the services and goods used by the business or professional people. The next one is balance sheet, the net worth. Net worth is the difference between what the family owns and what it owes. Assets are all the things which are owned by the family. Liabilities are what the family owner owns to others or owes to others. That is, all the loans and debts which the family has to repay. It is useful in both short-term and long-term planning computation of net worth of the family each year. The importance of net worth calculation cannot be overstated from the point of view of its supplying vital data for family financing. In fact, many would say that it is single most important financial record for the family because it gives basic information at least once a year on their economic status. Right. To conclude the session, we have so far seen the ability of families to meet their most basic needs, which is an important measure of economic stability and well-being. While poverty thresholds are used to evaluate the extent of serious economic deprivation in our society, family budgets, that is the income a family needs to secure safe and decent yet modest living standards in the community in which it resides, offer a broader measure of economic welfare. Keeping a record of income and expenditure is essential for good management of family finances. Records are classified into household accounts, ledger and balance sheet. Records relating to current cash expenditure from money income are commonly called as household accounts. In this, there are 4 types of accounting systems: sheet method, envelope method, notebook method, and card filing method. Always start account keeping with simple systems for getting into habit of keeping accounts and to have an idea of nature of expenditure incurred by a family. I hope that our viewers have been benefited by this session on family income and expenditure. Thank you for watching.